Your monthly bills include payments the federal government says you are not legally required to pay. If you are over 60, at least 5 of these charges are in your account right now. Insurance companies, banks, and service providers count on you never reading the specific exemptions buried in IRS and Social Security rules. This is not about being rich. This is about a federal protection that applies to everyone over a certain age, one that institutions have no financial incentive to advertise. Here are the 5 bills seniors are still paying that they can claim exempt from today. Most seniors believe property tax is something you cannot avoid. You pay it. That is just what homeowners do. But here is what almost nobody knows. Your state has already written an exemption for you into the law. It has been sitting there the entire time. You just have to claim it. Nearly every state in the country offers property tax exemptions for homeowners over 60 or 65. These are not brand new programs. They are not experimental. They are permanent exemptions written into state tax code decades ago. Some states exempt 10% of your home's assessed value from taxation. Others go up to 25%. On a $300,000 home with a 15% exemption, that difference means you pay property tax on $255,000 instead of $300,000. That compounds every single year you own the home. Let me give you the math. If your annual property tax rate is 1%, a 15% exemption saves you roughly $450 every year on that $300,000 home. Over 20 years of retirement, that is $9,000. Over 30 years, it is $13,500. That money stays in your account instead of going to the county assessor. And that is a conservative estimate. Many seniors have higher home values and higher tax rates. The first thing to understand is how the exemption works in your specific state. Some states apply the exemption automatically. Your county assessor processes it without you doing anything. But most states require you to file a form, usually called a homeowner exemption application or property tax exemption request. It is a one-page form. It takes 15 minutes. It is free to file. The second thing, and this is where the system breaks down, most county assessors are legally prohibited from recommending that you file this exemption, even though they process these applications all day long, even though they know you qualify, even though it is completely free. They cannot tell you it exists. That means you have to know to ask for it. If you do not know, it simply does not happen. I had a client, Margaret, who was 67 when she finally found out about this. She had owned her home in New Jersey for 32 years. She had been retired for 10 years. When she filed her exemption form, she discovered she had been overpaying property taxes for an entire decade. The county did not offer her a refund. She lost the money she should have had all along. Margaret did nothing wrong. Margaret is a retired teacher who just wanted to pay only what the law required, and that is exactly what this exemption is supposed to do for every senior in your situation. Your county assessor's office is legally prohibited from recommending that you file for this exemption, even though they process the application for free. Your bank is charging you money every month that it does not have to charge you. And the entire time, there is a free account sitting right there on their system with your name on it. You just have to know to ask. Banks charge monthly maintenance fees on checking and savings accounts, usually between $10 and $25 per month. Most seniors accept this as normal. It is just the cost of banking. But that is not actually true. Every major bank in the country has designed a specific account type, sometimes called a senior account, sometimes called a mature saver account, sometimes called a premier checking account, that waives these fees completely for customers over 55 or 60. Chase offers it, Bank of America offers it, Wells Fargo, Citibank, TD Bank, US Bank, they all have it. These accounts exist. They are legitimate. They are not promotional. They have been in place for years. But your bank does not advertise them next to your regular account. They do not call you and say, by the way, because you are over 60, you qualify for an account with 0 monthly fees. They wait for you to ask. If you never ask, they keep charging you. Let me show you what this costs over time. If you are paying $15 per month in maintenance fees, that is $180 per year. Over 10 years, that is $1,500. Over 20 years of retirement, it is $3,600. That money goes directly to the bank. You never see it. You probably do not even notice it. It just comes out of your account every month, every year, for decades. The first thing you need to do is call your bank directly and ask if you qualify for a senior account with 0 monthly fees. When you call, be specific. Do not say, do you have anything for seniors? Say, I am over 60. What accounts do you offer that waive monthly maintenance fees for my age group? They will know exactly what you are asking about. The second part is to understand what features come with that account. Senior accounts usually include the same checking and savings capabilities as your current account. Some include higher interest rates on savings, some include free checks, some waive overdraft fees. The features vary by bank, so ask what is included before you switch. I had a client, David, who was 72 and had been banking with the same institution for 40 years. He was paying $12 a month in maintenance fees. When I told him about senior accounts, he called his bank that day. They told him he qualified and could switch his existing checking and savings to the senior version immediately. His bank had known this the entire time. They had never mentioned it. David switched that week and saved $144 a year, money that now stays in his retirement account instead of the bank's. David did nothing wrong. David is a retired engineer from Massachusetts who simply wanted to stop paying for something his bank never told him he did not have to pay. And that is exactly what happens to seniors every single day. But the fee waiver is only the beginning. There is a separate exemption that applies to overdraft protection, and that one saves significantly more money for most people. Medicare Part B costs money. Most seniors know that. But what most seniors do not know is that your Medicare premium can be 2 times, 3 times, even 4 times higher than it should be based on rules almost nobody understands. The federal government has a system called IRMAA. That stands for Income-Related Monthly Adjustment Amount. What that means in plain English is this. If your income is above a certain threshold, Medicare charges you a penalty on top of your regular premium. Not a small penalty, a significant one. And the vast majority of seniors paying this penalty do not realize they have options to reduce it. Here is how it works. Medicare looks at your income from 2 years ago, not your current income, 2 years ago. Your 2026 Medicare premiums are based on what you earned in 2024. That matters because it creates a window, a specific moment where you can make changes to your income before it affects your Medicare costs. The first thing you need to understand is the threshold itself. In 2024, if you are a single senior earning more than $97,000, your Medicare Part B premium jumps up. For a married couple, it is $194,000. If you earn above those numbers, you do not pay the standard premium anymore. You pay the standard premium plus a surcharge. That surcharge can be anywhere from $70 to $560 extra per month, depending on how far above the threshold your income sits. For Part D prescription drug coverage, there is a separate surcharge on top of that. Same with Part A hospital insurance. On a Medicare couple earning $200,000 combined income, that surcharge can be $400 to $500 per month extra. That is $4,800 to $6,000 per year in additional Medicare costs. Over 10 years of retirement, that is $48,000 to $60,000 in surcharges alone. The second part is where most people miss the opportunity entirely. Legitimate strategies exist to reduce your modified adjusted gross income, that is the actual income number, Medicare uses to calculate your surcharge. Strategies like strategic charitable donations, certain types of retirement account withdrawals, or income timing can lower that number before Medicare enrollment calculates your surcharge. A tax professional or financial advisor who understands IRMAA can structure your retirement income to lower your premiums significantly. The third, and this is the critical one, the income threshold applied to your premiums is locked in the moment you enroll in Medicare. You cannot appeal it later. You cannot go back and file an amended return to reduce it. The deadline closes. That means if you are turning 65 and your income is $200,000, the time to act is now, not after Medicare charges you the surcharge. I had a client, Ruth, who was 64 and about to enroll in Medicare. Her income from consulting work was $185,000. Her advisor ran the numbers and showed her that by shifting some income into the following year, she could stay under the threshold and avoid surcharges entirely. One conversation with a tax professional saved her over $500 per month in Medicare costs for the rest of her retirement. Ruth did nothing wrong. Ruth is a retired consultant from Arizona who simply wanted to understand what Medicare was actually going to cost. And that is exactly what this income planning should do for every senior facing enrollment. The deadline to file for Social Security at age 62 versus 67 determines whether you pay these surcharges at all. A single year of delay eliminates an entire income threshold bracket. Your electric bill, your gas bill, your water bill, every one of them has a discount built in for your age. You are not paying it right now because nobody told you it existed. That is the only reason. Nearly every state in the country has utility discount programs for seniors. These are not experimental programs. They are not new. They have been in place for decades. They are run by utility companies and state regulatory agencies. The discounts range from 10 to 20% off your monthly bill depending on your state and which utility company serves your area. Here is what that actually means in your pocket. A senior in California using 500 kilowatt hours of electricity per month, that is a normal amount for someone running air conditioning, heat, refrigerator, lights, all the standard things, pays about $60 at standard rates. On a senior discount plan, that same 500 kilowatt hours, $45, that is $180 per year in savings. Just on electricity, now add gas. If your heating bill is another $100 per month in winter, a 10% senior discount saves you $120 per year on heating alone. Water bills often have discounts too, another $50 to $100 per year. You are looking at $350 to $400 in annual utility savings. Over 20 years of retirement, that compounds to $7,000 to $8,000. That is real money that stays in your account instead of going to the utility company. The first thing you need to understand is that utility companies do not automatically enroll you in these discounts. They do not call you up and say, hey, because you just turned 65, we are lowering your bill. They wait. They wait for you to request it. If you never request it, you pay full rate forever. They have zero incentive to tell you. The discount directly reduces their revenue, so they stay quiet. The second part is how simple it is to activate. One phone call to your utility company, one form. Sometimes just answering yes to a single question on their website. That is it, you are enrolled. The discount applies automatically to your next bill and every bill after that for as long as you live in that service area. I had a client, Frank, who was 68 and had been paying his utility bills for 6 years after retirement. His electric bill was consistently $65 per month. His daughter asked him one day if he was on a senior discount. He had never heard of it. He called his utility company that afternoon. They told him he qualified immediately and applied the discount to his account that same day. His next bill was $52. He had been overpaying by $13 every single month for 6 years. That was $936 he did not need to spend. Frank did nothing wrong. Frank is a retired accountant from Texas who simply wanted to pay his utility bill. He had no way of knowing a discount existed unless someone told him. And that is exactly what is happening to seniors across the country right now. Right now, you might be missing this discount on utilities you use every day, losing hundreds of dollars annually, simply because nobody told you it existed. You are paying for insurance that is not protecting you anymore. And the reason it is still coming out of your account every month is not because you need it. It is because you forgot it was there. Life insurance serves one purpose. It replaces income when you die. That is it. If you are the primary earner and you have a spouse and children and a mortgage, life insurance makes sense. It protects them. But if you are retired, your children are adults, your mortgage is paid off, and you have accumulated savings, life insurance is not replacing anything. It is just a monthly bill. Yet, millions of seniors are still paying premiums on policies they took out 30 years ago when their situation was completely different. A $500,000 life insurance policy at $35 per month costs $420 per year over 20 years of retirement. That is $8,400. Some seniors carry multiple policies from different employers or different decades, one from an old job, one they bought when they were 45, another one they forgot about entirely. That can easily add up to $50, $75, even $100 per month in life insurance premiums for coverage you no longer need. The first thing you need to do is open your financial statements and look for life insurance payments. Check your bank account. Check your credit card. Many people do not even know how much they are paying because it has been automatic for so long. Write down every policy you find. Write down the monthly or annual payment for each one. The second part is to ask yourself one question about each policy. If I died tomorrow, who would this money go to, and would they need it? If the answer is my adult children who have their own income and their own savings, the answer is no. If the answer is my spouse who has a pension and Social Security, probably no. If the answer is nobody really, then absolutely no. I had a client, Patricia, who was 71 and had been paying $42 per month on a life insurance policy for 23 years. She took it out when her youngest child was in high school. Her children were now in their 40s with families and careers. Her husband had a pension. She never even thought about the policy. It just came out automatically. When I asked her about it, she said, I do not think I even need that anymore. She called her insurance agent that week to cancel. Patricia did nothing wrong. Patricia is a retired nurse from Ohio who simply never revisited a decision she made 4 decades earlier when her life was completely different. And that is exactly what happens to millions of seniors every single day. You control this decision entirely. One phone call to your agent cancels the policy. That stops thousands in unnecessary payments across retirement. The money stays in your account instead of going to an insurance company for coverage you do not need. When you call your insurance agent to cancel, you will discover there is a surrender value waiting in your policy, something most people do not know exists until they try to cancel. I put together a free checklist that covers all 5 of these exemptions, plus 3 additional bills seniors are commonly overpaying. It walks you through how to claim each one and what documents you need. It is completely free. The link is in the description below. Send this video to one person you know who is over 60, a parent, a neighbor, a friend from church. The odds are good they are dealing with at least one of these situations right now. That one share could be worth more to them than anything else you do this week. Drop a comment below. Which one of these 5 surprised you the most? Read every single comment, and I want to know what landed for you.